Hello there and welcome to this video on using RRG in different time frames, or basically playing with time frames in general. In this video we're going to cover some time frame basics, the differences that you will encounter when you play with different time frames, how different time frames apply to relative rotation graphs, and in the end how you can actually make them work together. What are time frames anyway? When we talk about time frames in technical analysis, what we mean with a time frame is the periodicity, the interval between the observations on our chart. And you know, 9 times out of 10 people start with a daily chart for a security, and what we look at here is the daily chart of the S&P 500. And each bar represents 1 day of trading. The little notch on the left is the opening price for that day, and the little notch on the right is the closing price of the day. And then obviously you got the high and the low, which are at the extremes of the bar. So this chart gives you a pretty good insight on how trading during a specific day went. Again, this is a daily chart, so every bar is 1 day. Now, we can go to a weekly time frame. And that will basically compress those daily bars, because a weekly time frame represents the trading that takes place from the opening on Monday morning to the close on Friday evening. So 5 daily bars together will form 1 weekly bar. I'm recording this on a Thursday the 15th of December. So this is Thursday, Wednesday, Tuesday, Monday the 12th. And if I go back one more, then you will see that it is Friday the 9th. So this week is still ongoing, but you can already see how different those 4 bars are. And if we go to the entire week that ends on the 9th, so this is Friday, Thursday, Wednesday, Tuesday, Monday the 5th. So we open the week here, then during the week we go all the way down here to a low at 39.18, and then so this is Monday, this is Tuesday, and then we have Wednesday, Thursday, Friday. We end towards the low of the week. So these 5 bars represent 1 week. Now, in StockCharts.com, you can actually very easily change that. So we change the time frame here, the period, and we make that a weekly. And then you will immediately see how that changes the chart. You can see that this is that 1 week that we played out, those 5 bars, and this is the week that is still ongoing. And you can see that we opened on Monday morning here, then we had a very strong Tuesday, Wednesday, and then Thursday or Wednesday already we started coming down, and then now it's Thursday, we're already down here. But you can see that this chart has a lot less bars because every bar represents 5 days of trading. We can even go up to a monthly time frame that's even higher, so that's even more compressed. And this chart starts in August, at the end of August, so it's September, October, November, and then the start of December. So if we make this a monthly time frame, and by the way, I have my settings here are that I selected start and end, which is hard-coded, which means that no matter what time frame I choose, this chart will always show me end of September towards the current date. And the reason I'm doing that is because then I can show you how the chart still shows the same price movement, but in a much more condensed way. So if we upgrade to the monthly chart, then you can see that we only have 5 bars left. And these 5 bars represent exactly the same time period, the same duration as the daily and the weekly chart that we just discussed. Obviously, we went from daily to weekly to monthly, and we could even go to quarterly and yearly, which is super long. So if you want to look at really super long-term trends, you may want to look at quarterly or even yearly. We'll leave that for now, but I think you get the idea. But we can also go the other way. So what we've discussed here, so daily, weekly, monthly, and maybe even higher, these are called end-of-day timeframes, EOD timeframes, because they're based on the closing prices on the end-of-day results. The minimum time frame here is a daily chart, so end-of-day, and we can put 5 end-of-day charts into a weekly, and etc., etc., etc. Now we can also go the other way. We can also break a day down into shorter time frames like hourlies or 30 minutes or 10 minutes. And there is a whole list of intraday time frames on StockCharts.com, which is below the dashed line here. Goes all the way down to 1 minute, 1, 2, 3, 5, etc. Now we've got a number of special time frames, which is the 39, which equals 10 bars per day, because the problem, if you wish, is that when you, for example, work with a 60-minute time frame, the trading day is 9:30 to 4 p.m. That is 6.5 hours. So if you would set it to an hourly chart, so the first bar will only be 30 minutes of trading, and then it'll be hourly. On the top of the hour, it switches. So if we look at the chart, if we make this S&P chart into a 60-minute chart and update it, then you will see that, so here is the bar that ends. It's 3 o'clock, so that's the start of the bar. So this is the bar from 3 o'clock to 4 o'clock until the close. And then the next open, the first bar really there on the high, it starts at 9:30. And then the next bar starts at 10. So this bar here, that first bar, is only 30 minutes of trading. And then we move to hourly increments again. If we solve that, if you go to like 39 minutes, it's 10 bars a day. So 30 minutes would work because that's actually 30-minute increments, that works. But if you go to 65 minutes, that's 6 bars per day. That is how you need to read those intraday timeframes. The best way to look at the differences between these timeframes and how they interact together is to put them side by side. So I now have the daily chart of the S&P 500 on both sides of my screen. So both sides are a daily chart. Now let's change one into the weekly time frame. So the left chart is now a weekly time frame. So now you can really see how different the movement on the weekly is with the daily. They're still the same time span, they're covering the same period of time, but you can see that the weekly is much more smooth, much more gliding here. There is not so much noise. While on the daily chart, you can see a lot of day-to-day action, day-to-day noise. That's what everybody's talking about, day-to-day noise. And you don't get that on the weekly. So for me personally, that's why I prefer to look at weekly charts most of the time, because they give me a longer term perspective. They're much more granular, and it just fits my investment style. It fits my trading style. I think it's very important to actually always at least have your higher time frame on top of your mind and looking at that. So that's why in my show Sector Spotlight, every month I look at the monthly charts, because that's my next higher time frame. So if you're an active trader or a swing trader and you prefer to look at daily charts, I would always suggest that you keep a weekly chart somewhere at hand to be aware of the bigger trend, what's going on. So that's how you interact with the two. And obviously, I can do the same the other way around with these. So this is end of day. So I can make this back to a daily, update, and then turn this one into, let's say, a 30-minute. So that is 13 bars per day. And now I got this, so I can see how much more detail I can see on this 30-minute chart than I can see compared on the daily chart. So that's how you want to compare those different time frames together to make up your mind. It's actually, I think the best way to explain it is that you want to build a picture in your head, and using various time frames will help you to understand the entire picture, to be aware of the shorter term movements and maybe have an idea, have a gauge to see whether that shorter term movement preludes a bigger move on your next higher time frame, or whether you can just sort of ignore it or see it as noise because the trend on your higher time frame is still there. So there's a lot of value in comparing those time frames with each other and keeping them side by side on your screen or in a chart list or wherever you keep them. And I actually found a very good example of the interaction between daily and weeklies on Google. And I went back to 2021. This chart goes back to 2021, so May to the end of the year, so second half of 2021. And both charts are showing the same time span. So here is May, April, so June starts here, and then it goes until the end of 2022, which is right here. So here is December 2021, sorry, 2021, and here is December 2021. So it's the same time frame, same time period, same time span. Now look at this here. So you look at the Google chart on the weekly, you see high, low, moves all the way up, you see a high, low, high, low, high. So Google at that time was making a very nice series of higher highs and higher lows on the weekly time frame. And we all know higher highs and higher lows means that the stock is in an uptrend. Now, look at this daily chart here. You can see there is much more granularity, but watch the month of September. On the weekly chart, this is going from a high all the way down to a low, just nicely stacked bars, moving a little lower every week until a low is in place, and then we start moving higher. On the daily chart, you see a very nice series of lower highs and lower lows. So you got high, low, high, low, high, low, high. This is a downtrend. So on the weekly chart, it's still a full-fledged uptrend. There's no doubt about it. Higher highs and higher lows. If you go to the daily, you can see that the month of September for Google in 2021 was actually characterized by a series of lower highs and lower lows, i.e. a downtrend. So depending on where you're coming from, depending on what your investment horizon is, you would not be worried at all on that weekly chart because you're still in that rhythm of higher highs and higher lows. If you're on the shorter term time frame, you would have probably gotten out when some of the previous lows were broken and maybe get back in when the new series starts. So point I'm trying to make is that depending on what your investment horizon is and what the main chart of trading for you is, it can be very different. So here in Google in September 21, this was a clear downtrend, lower highs, lower lows, while on the weekly chart, it's just a little blip inside an uptrend, a series of higher highs and higher lows. And that's the way you should actually keep it in the back of your mind. Different players have different time frames, have different investment horizons, and there are different charts to cater for those different horizons. When we bring this concept to RRG, to relative rotation graphs, the interpretation is not much different. Because in the end of the day, RRG is another form of charting securities. So the trading system doesn't signal anything. It's just another way of visualizing market rotation. And so there's also a time frame involved, and you can select that on the top right of the RRG page. So here's the weekly, and here is the daily time frame. which is essentially the same as when we spoke about bar charts. So on the weekly time frame, every endpoint, every point is a week. Every increment is 1 week. When you go to the daily, every increment is 1 day. So these 5 trading days basically represent 1 week on the weekly. On a regular basis, I get emails or questions through other channels of people who say, hey Julius, I am looking at RRG and security XYZ is in the leading quadrant on the weekly RRG, but it's in the lagging quadrant on a daily RRG. How is that possible? The answer is simple, just because it's a different time frame. Just why we just saw that downtrend in Google on the daily, while it's fully in an uptrend on the weekly. So when you see a security, so let's stick to sectors for ease of use. When you see a sector inside the leading quadrant and you see the same sector in the lagging quadrant on the daily, the first thought that you should have is, hey, this sector is in a long-term relative uptrend, but it's going through a correction because the daily rotation is taking it through the lagging quadrant. That's the immediate response that you should have. And there's actually a good example in consumer discretionary that I found, so XLY, which I basically want to play out for you, want to talk you through the entire period. So let me highlight XLY, which is right here on the daily, and it is right here on the weekly. And you can already see some differences. But it becomes really interesting when we scroll back to the start of October. So let's go, you can actually look at the date right here. So what this means is that the last point on the tail is now the 2nd of December. So I'm going to scroll back to first week of October. And that's right here. So when the daily actually crosses over from weakening into lagging. So let's put that weekly tail there as well. So that is the week that starts on October the 3rd. So we're now at exactly the same place. So you can see that on the weekly, this tail started to roll over, and you can see that the daily is actually leading that way. Now, what we're going to do is do I need to go forward. 1, 2, 3, 4, 5. It's 5 trading days. I need to do 1 on the weekly. So now you can see that we're October 10 and October 10. And you see that that weekly tail moved further down, which is understandable by the further weakness on that daily. Now we go 1, 2, October 10, select this one. 1, 2, 3, 4, 5. And you can see 1. So we're October 17. The move in that little hiccup is not visible on that longer term trend. So let's go 1, 2, 3, 4, 5. You see a recovery in XLY. It's actually picking up momentum. On the weekly, where also October, it's completely invisible. So this is sort of noise. We go further, 1, 2, 3, 4, 5. And now we go on the weekly, 1. So we're now at the end of October. So that rotation here, you saw that rotation moving all the way here. It's not even visible on that weekly tail. 1, 2, 3, 4, 5. Now we're getting back down. And here, we're now moving further down. And this is what I'm trying to explain when I talk about tying these two together in Sector Spotlight. Because if you go back to October 31, we go back to October 31 here. Now here we are in improving, and here we are way down. So to me, this is very clear. This is a long-term relative downtrend, and this is a hiccup. So what am I looking for at these points in time? I'm looking for that XLY tail to rotate back down and get back in sync with that weekly tail. Because then I've got both time frames moving in the same direction. That gives me extra comfort, extra confidence that we're actually moving into that direction, that we're again accelerating with that relative downtrend. And that's what we're happening here. So 1, 2, and now we move over, we roll down 3, 4, 5 here. So now we're pointing in the same direction. And now you see what's happening on that weekly. So here, it's November 7, 1, 2, 3, 4, 5. This is the end of the week. Well, this is the start of the week here. And now we go here. So now we're both at November 14. And you can see that we had that complete rotation, didn't impact that weekly tail. So let's continue here. 1, 2, 3, 4, 5. Again, we go in a hiccup, and it's barely visible, not even, on that weekly. So we got another recovery within that longer term downtrend. 1, 2, 3, 4, 5. Boom, here you go. I went one too far. So now 1, 2, 3, 4, 5. And now 1. We continue to move, that XLY tail continues to move into that lagging quadrant, while that daily rotation is much more volatile, much more going, but it's all happening inside within that longer term downtrend. So here is December 12th. That's actually the last point in time because it's the 15th of December. This week started on the 12th, so it hasn't finished yet. And here we have one more. So here we now also on the 15th. So 16, 17, that's the end of the, tomorrow is the end. So December 16 is the last day. We got one more observation here. But I can tell you already that whatever happens here, it's not going to change the point on this tail very much. And what I'm trying to make clear is that you saw that rotation taking place on that daily time frame, which hardly is impacting the direction of that weekly tail. The way you use it is because right now what you can see here is that XLY is actually starting to pick up and move in sync again. So it's a pretty good moment to actually, whatever your strategy is, play a relative underperformance for XLY versus the S&P 500 and the other sectors, because you can see that the daily chart, the daily tail is now starting to reinforce again what's happening on that weekly tail, on that weekly RRG. As we recently introduced intraday time frames on relative rotation graphs, we can now also go to more detailed analysis of rotations on intraday levels. So when I would change this weekly to a daily and update this chart, and let's stick with XLY for a moment. So this is now the last 5 trading days of XLY. And I move to the hourly time frame on the RRG. And now 60 minutes, that's roughly, I said, like 6.5 hours in a trading day. That means that a 30 period is roughly that 5 days. It needs a little bit more, but maximum is 30. So 30 periods, 30 hours, roughly equals 5 trading days. And if I now look at the rotation of XLY, you can see that that main trail here on that daily is still moving lower. And you can see that on the intraday time frame, on the hourly time frame, XLY made an almost complete rotation from leading through lagging, back up into improving, and now going back into leading. And this is how you can actually try to interact and try to do the same thing as we did with the dailies and the weeklies. You can do that with your 60-minute and your daily chart. Or maybe if you're super aggressive, go to a 60-minute and a 5-minute RRG. I mean, there is ways and tons of possibilities to actually make that work, to make those time frames interact with each other. And since the introduction of intraday time frames for RRG, we can now also do that on an RRG and not only on a price time chart. I would never advise someone to trade solely off an RRG, because RRG is an overview chart. It gives you the big picture in one picture. So eventually you need to move to the price chart, to the just regular price time chart, to actually see whatever is happening there and whether it fits your trading style. Now, Relative strength, and especially RRG, is all about comparison. It's all about relative strength. And relative strength is very important that you compare apples and apples and oranges and oranges. So when you start using RRGs together with price charts, it's very important that you use the correct price chart with the correct RRG. Sounds like an open door, sounds simple, but you would be surprised how many people are still mixing things up. So when you have a weekly RRG and you want to combine that with a price chart, you want to look at a weekly price chart. And I do that in combination with relative strength in the RRG lines because that dictates what's happening right here. And as you can see, this move here, so this is the last 5 weeks, that is 1, 2, 3, 4, 5, that's right here. You can see when that red line crosses below 100, that's when the tail here crosses into the lagging quadrant. So that is this type of move. That's almost straight down, which is exactly what the RRG is showing you. Now, if we flip that around and we go to the daily RRG, we need to look at the daily price chart because that's apples and apples and oranges and oranges. And if we go back 5 trading days, or we go back to the period that we just played, which was from October, from the start of October, that's right here, then you can see this period here in terms of what happened in terms of relative strength and the RRG lines. You can see those jiggly moves, those up moves. That's what we see. That's what we saw in that rotation from weakening into lagging, back up into improving, back down to lagging, back up into improving, and now moving back down again. Those are those oscillations of that green RS momentum line around 100. That's exactly what you see on that RRG. So when you start combining RRGs and regular price charts, make sure that when you look at a weekly RRG, you use a weekly price chart. When you look at a daily RRG, you look at a daily price chart. And when you compare them side by side, make sure that you got the daily and the weekly and you know what the difference is and why they are moving in different directions. And that wraps up this chat on various time frames, how to apply them to various chart formats, and how to make them work together. I hope you enjoyed this program, and looking forward to see you again here at StockCharts Television.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.